variant. But as many of us experience, I'm sure many of us experience getting infected this time around. It was not as severe, less hospitalizations, and I think that is because of two things. Number one is the vaccination, it's working. And the number two is that we're almost 2 years into this. For sure, we have already learned how to live with this virus. Okay, so what happened during the fourth quarter of 2021? So we saw more market activities, more inquiries, more transactions. We will show you later that transactions year on year were up 18%. So that means that 2021 was better than 2020. And with that, we're expecting this year to be a lot better than 2021. Yes, Omicron variant ravaged us at the start of the year, almost 40,000 cases daily, and that delayed the return to office. But we did not see, or we only saw a pause in terms of market transactions. So even during the height of the Omicron surge, we are still very busy catering to a lot of studies being conducted by various occupiers, trying to figure out what's going to be the future of work for them. And then, of course, despite the positivity that happened, in fact, we saw transactions or the office market starting the rebound as early as August last year. This is not to mean that the vacancy will already start going down because there will be a lot of supply. In fact, for 2022, we're expecting almost 900,000 square meters. So that means that the vacancy will continue to increase, albeit more flattish growth. More flattish increase in vacancy, and that also means that rents will continue to fall this year. Okay, so as I've mentioned, look at this is the quarter-on-quarter level of transactions in 2020 and 2021. Look at the dark blue bars. Those are the quarterly transactions for 2020, and at that time, right after a surge. So we experienced the surge in the third quarter of 2020 and look at what happened in the level of transactions in the fourth quarter. There was a significant reduction. And then compare that with what happened during the Delta variant surge in August of 2021. So we only recorded 69,000 square meters of transaction in the third quarter last year, but that almost doubled in the fourth quarter of 2021. So we did not experience the immediate impact of the reduction of transactions this time around. So that only means that, as I've mentioned, vaccination is working. We have learned and continue to learn how to live with this virus. And also, while the health concerns brought about by the COVID-19 are already being addressed, we're more confident. That means that there's more focus now in terms of reviving the economy and the businesses. So with that, the annual transaction increase was 18% last year. So moving on to the specifics of the office market report. In the fourth quarter, we saw completions. This building completions in the fourth quarter, SM Fairview, this is fully leased out. One building in Makati, 3 buildings in Alabang. So this brought the office stock to almost 13 million square meters. So the completion in 2021 is up by 48%. Okay. Yes, the completion is up by 48%. So 13 million square meters of office stock. And this year we're expecting almost 900,000 square meters, and more than 250,000 square meters of this were delayed from 2021. So a lot of the stock will be coming from the markets of Quezon City, Ortigas, and Fort Bonifacio. So we recorded the vacancy as of end 2021 at 15.7%, which is equivalent to about 2.03 million square meters of available spaces. Now we're showing here the different periods relevant to our discussion today because this year is an election year and we're comparing what happened in 2016 that the election year or every election, especially the national elections, would cause a wait and see scenario. And that is exactly what happened in 2016. There was a slight dip in terms of the demand, but this time, and we have a separate slide later on with respect to the regulatory and business environment. Yes, we will expect a wait and see because of the national elections, but I think the pressure to revive the economy, pressure to revive the businesses is greater than the impact of the national elections, the uncertainty that comes with it. And that is because also some of the important legislations required to stimulate the economy were already passed or are being finalized at the moment, like the CREATE Bill, the Public Service Act, and the others. So 15.7% vacancy as of end 2021. We expect that to increase this year. And that is because of a supply-driven scenario wherein we're expecting 900,000 square meters. And then from that point on, and provided, of course, that if many of the studies are saying are true, that we're about to enter the endemic phase already of the COVID-19 pandemic, then we expect the 19% to plateau already and then start falling down by that time, by 2023. So the 2,030,000 square meters of vacant space in Metro Manila, that's equivalent to 67 buildings of empty space. And based on pre-COVID level or market size of about 500,000 square meters, the absorption period is expected to be 4 years, unless, of course, we enter the endemic phase and we see significant growth moving forward. So, despite the passage of the CREATE law that harmonized the tax incentives across the different investment promotion agencies, we still see PEZA to be very relevant in terms of the influx of the BPOs. So we continue to monitor the availability of PEZA spaces in Metro Manila. So 50% of the available spaces in Metro Manila right now are all PEZA registered. And you can see where these PEZA spaces are located. Quezon City is number 1. You have Fort Bonifacio. So there's an array of choices for occupiers, and we really encourage them to monitor and start looking at various options in preparation for the back to office and future expansions. Upcoming supply, there's still substantial available PEZA spaces, and we heard that PEZA is and the industry is lobbying hard to lift the moratorium on the PEZA approvals in Metro Manila. If that happens, then we expect more PEZA spaces available in Metro Manila. So this slide shows you the vacancies across the various submarkets. And unfortunately, all submarkets except Makati CBD have exhibited double-digit vacancies already. So this means that, and the vacancies continue to rise year on year. So if you're seeing red figures here, that means the vacancy has increased. So the biggest vacancy was recorded in the Bay Area. It used to be 6.7% year on year, but it already jumped to 28% because of non-renewals and pre-terminations of POGO companies. And then on the right side, you can see the absolute amount of available spaces in the various locations. In terms of rental rates, so we predicted a decline last year and we recorded 12% reduction year on year. And with the expected further increase in the vacancy in 2022, we expect about 7 to 10% decline in rents. So rents in most areas except Makati and BGC have already fallen below 1,000, the 1,000 level mark, or significantly lower than that. Makati CBD and Fort Bonifacio, although they're still transacting at above 1,000 pesos per square meter, they're already transacting close to that mark already, and that is coupled by, of course, delayed escalation, other flexibilities like rent-free incentives and whatnot. Some developers are also offering tenant improvement allowance to manage or to make it more affordable for occupiers. And that is to increase the vacancy. We also observe that at some point, even if we're saying that the vacancy or the rent would continue to decline, some landlords in particular locations would want to hold on to headline rates, but that is not to mean that that is the effective rent. So landlords are becoming more creative in the way they are structuring deals right now. Okay, so there's again talks about the POGOs, and we saw how relevant they are. If you look at this graph, they caused the Philippine office market to increase from 500 to 600,000 square meters to 800 to 1 million square meters at some point, right? So over the course of 2 years, we saw them shedding almost 50% of their occupied space. So prior to the pandemic, they were occupying 1.3 million square meters. That's down to just 680,000 square meters. So the question now is, are they going to come back? So there are three relevant issues with respect to that. Number one is the uncertainty of our tax system with respect to the POGOs, but that has been resolved already with the passage of the new law taxing the POGOs with 5% based on gross gaming revenues. Number two is the travel restrictions. Now, with the improvement in the COVID-19 situation, we're expecting travel restriction to start easing up. So that's going to help the industry. And number three, and that's the most important, is the level of tolerance of course, the home country of these companies, which is China, in terms of allowing their workers to work in to work outside of China, say the Philippines, to operate online gaming or online gambling operations. So the third one is something that I think we don't have any control over that. It's really up to China, and the result of the Philippine election could tell us what's going to happen with respect to this one. Okay, so with that, and in terms of our previous, in terms of our official forecast here, we are not considering POGOs in terms of our projections, but we did a simulation or a sensitivity analysis in terms of what if the POGOs will really come back this year. So that's going to be on top of whatever net take-up we projected previously, as shown in the previous slide. So if the POGOs come back and say the saturation point is 1.3 million square meters, previously they grew to that size in 3 years, probably this is how it looks like. So if the POGOs will come back, we see vacancy reducing significantly from 19% to just 12% until 2025. So I think the Philippines has already signified its openness by passing that new law taxing the POGOs. Easing of travel restrictions, that's going to happen soon. So it's really up to that, probably the Philippine-China relations with respect to the level of tolerance in allowing this industry to prosper in the country. Okay, so how does the office transactions look like across the Philippines? It remains to be 80-20. split between Metro Manila and the Philippines. Somehow I was expecting that the provinces would start having an increased share because of the decentralization that's happening, the improvement in infrastructure. But it remains to be Metro Manila 80% and 20% in the provinces. I think this will continue because as the Metro Manila market eases, some locators, say in Cebu or in Clark, are beginning to realize that they can also operate in Metro Manila because a lot of the BPO started operating in the provinces and the movement is from the provinces to Metro Manila. It's the reverse, right? So I want to discuss also in this slide what drove the market. So in Metro Manila, in Ortigas CBD, we saw significant transactions from e-commerce companies like Shopee. We saw Legato Medical signing up in Ortigas and some other BPOs like Insight, and then traditional occupiers like Grab and some other government agencies signing up spaces. In Fort Bonifacio, JP Morgan continued to secure more spaces. That's on top of their 70,000 square meter consolidation. We saw a travel BPO signing up and e-commerce company, probably Lazada in Fort Bonifacio. In Quezon City, we saw some BPOs like Acquire Asia, Lorica, and Wipro signing up spaces. And the one I'm telling you about, that an occupier from Clark signed up a space in Quezon City, and that is their first site in Metro Manila. In the provinces, well, Cebu continued to be the top notcher in terms of sign-ups, BPOs, traditional occupiers like SGB, and some government agencies. We'll see how the Typhoon Odette would impact the office market in the first quarter. Iloilo is the superstar over the course of 2 years because that's where a lot of BPOs, mostly healthcare BPOs, expanded. And vacancy is very low in Iloilo. Pampanga, we saw several BPOs signing up in that location. So deep diving into the different locations in the provinces. So we're showing here the vacancies, the rental levels, as well as the available PESA spaces in the various locations. So, well, we advise tenants to look at Cebu. Of course, you need to be careful because of what happened recently with Typhoon Odette. You just need to do your proper due diligence. But in terms of the office market dynamics from a tenant's perspective, there's a lot of opportunities there because of the 26% vacancy and more than 300,000 square meters of office supply available. Pampanga, 17% vacancy, 40,000 square meters of available PESA spaces right now, and additional 160,000 square meters of office spaces until 2020. Iloilo, that's where a lot are still interested, but you need to be opportunistic in this location and start earlier than your planned expansion because the market is tight, only 7% vacancy and only 8,000 square meters of available space. And these 8,000 square meters are just converted spaces. So we will only see additional spaces in Iloilo by third quarter, fourth quarter this year. Now, there are a lot of talks about the work from home, the remote work, the hybrid work model. And with respect to the PESA registered business enterprises, I think PESA already recommended to FIRB the extension of the work from home. And I think what's critical for occupiers is not really I think occupiers would want to be in the office, but it will not be 100% because it's already proven that work from home works or remote work works. That's why hybrid would happen to many companies moving forward. What companies are resistant of is that they're being mandated by PESA to go back, right, to increase capacity. And I think these companies, depending on, if you look at, of course, it's a free market, right? There's a natural tendency for them to go back, depending on the demands. And we already realized that this will be triggered by competition in the BPO industry, for example. That say if a BPO operating, say, 80-90% in the office is providing a higher service level than a BPO operating in a hybrid work model, then that's gonna drive competition, and that will drive the other company to increase the capacity in the office moving forward. So I think this is good news for the industry, because health and safety remains a top concern of BPOs. Now, I already mentioned that, of course, it's an election year, but we are closely monitoring the regulatory and business environment in relation to the stimulation of the economy. And these are some of the significant legislations passed or about to be signed into a law that will stimulate the rebound of the economy. Create law that was signed last year, so that is providing stability in terms of the tax regime of the country. And we expect this law to cause new entrants to come into the Philippines, new investments, new foreign direct investments because of the lower corporate income tax of 25% and 20%. Now, the next one is the Public Service Act. So this was recently ratified by Congress and is now in the office of the President for signing. This will open 100% foreign ownership in telecoms, airlines, railways, and subways, domestic shipping, airlines, highways, and airports. So essentially, it's about the digital and physical infrastructure. Imagine the impact of increased competition in terms of the telecoms industry. That's going to result in better service and lower cost. So the BPOs would like this, and that's going to cause more BPO companies to invest in the Philippines. The Foreign Investment Act is something that encourages foreign experts to bring their practice and expertise in the country, and this is expected to boost startups, particularly in the fintech or tech industry. And then the last one here is the Retail Trade Liberalization Act. So this reduced the paid-up capital for foreign retailers to just 25 million. So all of these things combined would cause more investments in the country. So having said that, what do we recommend for landlords? This we didn't change any. We still recommend the same things for landlords as we said in the last property briefing. Highlight building features, the health and safety features of your buildings as differentiators. That's very important. Be flexible with the handover conditions. If a tenant vacates the space and would want to leave behind the improvements and the improvements are in good condition, take that opportunity to allow the tenant to leave the space as is and rent it out in fully fitted condition. That is more desirable for tenants. Communication is very important. Talk to your clients or occupiers so that you may understand their needs and be able to come up with something that will be enticing for them to continue the occupancy in the building. Again, be creative in structuring deals right now. So landlords may want to protect headline rents. That's totally fine. Tenants would understand that, but of course, understand also where tenants are coming from and be able to address them by being flexible in other matters like escalation, rent-free periods, and probably in some cases, tenant improvement allowance. And then lastly here, just because we're showing you high vacancy doesn't mean you need to turn off the plug. Continue to monitor what's going on in the market. As I've said earlier, there is a chance that whatever we're forecasting could be exceeded depending on how we come out of this pandemic to endemic phase. Now for tenants, of course, if the business is uncertain for you, talk to your landlord, explore short-term leases, or if not, just sign up in a flexible workspace just to manage your fixed expenses and be able to grow moving forward. And then now is the time to renovate. As I've said, if not for the Omicron variant, the back to office would have happened or would have started in the first quarter, but that is now delayed to at least the second quarter. But right now is the time to renovate, entice your employees to come back to the office by designing an office that is somehow mimic some of the features of their homes. Okay. For those who are in an expansion mode, and then the lease are or your leases are expiring, take advantage of that to either right size, expand more, and sign up more favorable deal structures in the market and longer lease terms. And then if your lease is not yet up, probably you can again speak to your landlords and figure out a way how to make it more comfortable for the both of you so that you can continue or do an early renewal for another 3 to 5 years. That's it. Thank you very much. And I now turn over the floor to Joey for a call break.